I'm recording this video in the middle of April 2025. Have you seen the markets lately? Yup. In the matter of just a couple of days, I mean, maybe you can look at it as a couple of weeks, we've seen about a 10% drop. Things feel like they're in total disarray. We've got all this tariff information, possible recession worries, slowdown of the economy. So the headlines are loud and really the uncertainty is real. But here's one thing, this kind of moment just presents us with one of the most important lessons that any investor should put in the back of their mind. So let's take a step back and just zoom out. So let's look at some long-term historical returns dating all the way back to 1923 to the current date of 2024. You'll notice that stocks have returned roughly 10% per year. Bonds have returned roughly 4.5%. Cash around 3. So if you're a long-term investor, you might say to yourself, well, why do stocks return more? The answer is risk. You're being rewarded for tolerating the market's ups and downs. Cash is safe. You put it in the bank. It earns a little bit of interest. You know it's going to be there. It's not going anywhere. Bonds give you a little bit more, where you're basically loaning your money to either like a municipality or a corporation, and so you're collecting interest along the way. But stocks, now you're the owner, and just like any business owner or any business entity that's out there, you're going along for the ride. There's going to be ups and there's going to be downs. There's going to be even drama along the way as well. But if you can hang in during the dips, you'll get rewarded for higher expected returns. It's the volatility that really creates a lot of the tension for most investors that are out there. And that's the price that you pay for growth. Now let's look at this. If you closed your eyes in March of 2009 and then opened them up in March of 2025, you'd see a nice straight line up. It's about 16% return per year. But here's what the smooth line hides. The S&P on average experiences about a 14% drop each year. That's the peak to trough decline, which is basically the biggest drop in any given year. Yet despite that, the market finishes roughly positive every 3 to 4 years. This chart shows it all. The blue bars, that's where the market finished for that particular year. The red dots are the lowest point in that given year. Almost every year has a pullback. But then again, most years finish in the green. So I remember the first time I saw this chart, I thought it was just very interesting, right? Everybody focuses on the negativity of the market, being very bearish. Hey, is this the right time? Is this the wrong time? And when things do go down or they're not going as well as what most people thought, they start to panic and second guess themselves. Hey, should I go in? Should I not? Those are the types of comments and questions that I often get from clients. So let's look at what exactly is peak to trough. It's the drop from the highest point in the market, which is the peak, to the lowest point after, which is the trough. A really good analogy is to think of it like hiking. The peak is the summit, the trough is the valley below. So if we use an example and we say the market was at 4,800 and it dropped to 3,600, well, that's a 25% decline. It doesn't mean you lost money. It just means that the market dipped before actually recovering. So the recovery is really the key. Now let's talk about how often this really happens. So on average, there's roughly 3 pullbacks of at least 5% in any given year. 10% corrections happen every 1 to 2 years, and 15% drops happen every 2 to 3 years. And bear markets of at least a drop of 20%, those happen every 6 years on average. So yes, volatility is common. It's expected. It's normal. These are reasons to sell. And this chart is one of my favorites because basically what it's showing is that over 35 years of stock market history, there's been significant events that have happened that have made people want to not invest in the market. So let's take a look at them. The purple line, that's the return since 1989. It's up over 3,200%. That's more than 10% a year. Along the way, what happened? The dot-com bubble, 9/11, the great financial crisis, COVID, inflation, rate hikes, geopolitical risk. These are all legitimate reasons that when I've sat with a client or somebody that I wanted to work with, they maybe pump the brakes as to why is not a good time right now. But the key takeaway from this particular visual is that the market kept going. Volatility isn't the enemy. It's just the price of admission for long-term returns. It's the emotional toll you pay for long-term growth. So the next time headlines feel overwhelming, remember this: volatility is normal and long-term investors will be rewarded. Reacting emotionally is really what hurts returns. There will always be reasons to sell, but staying invested, that's what works. And there's been countless studies to go back and show this. So this was a kind of basic video, and it kind of coincides with another video that I did a couple months ago about being diversified and going through this whole market downturn related to the tariffs, everything else has really just been another kind of reason as to why you should be diversified and why diversification works and why markets will come back over time. There's so much data out there. If you're a long-term investor, you just have to stick through things. So if this video helped reframe how you think about volatility, give it a thumbs up, because that's ultimately how we grow as a channel and we can bring more information to you. And if you need help with thinking about volatility and how to construct a portfolio to weather times like this, all you need to do is reach out to us via email. Can't leave any comments below. Love your compliance. But again, if you like the video, please give it a thumbs up, subscribe. That way you can stay informed of all of our other videos that we'll continue to produce as we go along. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.